Today we're taking a close look at PVH, MongoDB, Cracker Barrel, and Ciena. Their latest earnings are out, and there's a lot to unpack. Let's break down the numbers, the signals, and what really matters for investors. Starting with PVH, the parent brand behind Tommy Hilfiger and Calvin Klein. Revenue came in at $1.98 billion, a modest 2% increase year over year. Adjusted EPS hit 2.30, slightly above Wall Street expectations. But on a GAAP basis, earnings dropped to minus 88 cents, driven by a goodwill impairment linked to underperforming international segments. Margins are under pressure, especially in Asia, where discounting is starting to bite. And with the revised full-year outlook trending lower, the company is bracing for a slower year. Tariff exposure sits at a moderate level, especially if tensions flare with China or Europe. North America remains steady, but overseas softness is starting to weigh. Guidance trimmed, growth muted, and caution rising. Verdict: neutral, stable, but not exciting. MongoDB came in swinging this quarter. Revenue reached $549 million, up 22% year over year and well above expectations. Adjusted EPS landed at $1, crushing the consensus of 66 cents. Atlas, their cloud database platform, now accounts for 72% of total revenue and keeps growing fast. They added over 2,600 new customers, the biggest jump in more than 6 years. Operating income is up, margins are expanding, and they just announced $1 billion share buyback. On top of that, they raised their full-year guidance across the board. Tariff exposure is minimal, but macro pressure on IT budgets still lingers. That said, the fundamentals look clean, and the growth story is intact. Verdict: bullish, cloud momentum, strong execution, and solid financials. Cracker Barrel delivered a mixed bag this quarter. Revenue came in at $821.1 million, up just 0.5% year over year, slightly below expectations. Adjusted EPS was 58 cents, beating estimates of 26 cents, but down from 88 cents a year ago. Restaurant sales rose 1.0%, while retail sales declined 3.8%. Net income improved to $12.6 million, a turnaround from a loss of $9.2 million last year. Adjusted EBITDA increased slightly to $48.1 million, maintaining a 5.9% margin. The company reaffirmed its full-year revenue guidance between $3.45 billion and $3.5 billion. A quarterly dividend of 25 cents per share was declared, payable on August 13, 2025. Verdict: neutral. Stable performance, but challenges remain. Ciena delivered strong revenue growth this quarter, with revenue reaching $1.13 billion, up 23.6% year over year, surpassing expectations of $1.09 billion. However, adjusted EPS came in at 0.42, missing the anticipated 0.52. The company's GAAP net income was $9.0 million, or 0.06 per share, a turnaround from a net loss of $16.8 million, or 12 cents per share, in the same quarter last year. Adjusted EBITDA increased to $116.7 million, up from $85.8 million a year ago. Despite the revenue beat, gross margins declined to 40.2%, down from 42.7% in the prior year, raising concerns among investors. The company repurchased approximately 1.2 million shares for $84.3 million during the quarter, indicating a commitment to returning value to shareholders. CEO Gary Smith highlighted strong demand driven by cloud and AI, reinforcing a positive outlook for network infrastructure investments. Verdict: neutral, impressive top-line growth, but margin pressures warrant caution. And that wraps up today's earnings rundown. 2 bullish plays and 2 with some clouds on the horizon. Let me know in the comments, which stock are you watching closely right now? If this helped simplify your research, make sure to like, subscribe, and tap the bell. And I'll catch you tomorrow with more earnings to break down fast. Disclaimer: this isn't financial advice, just data, context, and a bit of perspective. Always do your own due diligence before investing.